what's happening in the cryptocurrencies are indicative of where the economy is going. Because when you get to 2.4, 2.5 times GDP in terms of stock market capitalization, stock market becomes the economy. All my leading indicators are pretty negative, and with one major exception. This gold right now versus its 60-month, 30-month, 40-month, 50-month moving average is the most stretched in probably almost 45 years, right there, those peak in the late 79 and 80. So it's very stretched. But one thing that's never happened is gold has never got this high velocity of a rally relative to most of its moving averages.
Okay, ladies and gentlemen. So today we have Mike McGlone on our show, who is a senior commodity strategist at Bloomberg Intelligence. And today we will look at the US economy, commodities, precious metals, and many other very interesting topics. So Mike, thank you so much for being back on the show.
Hello, Vladyslav. Thank you for having me back on.
It's a pleasure to have you back, sir. Very busy time, so much happening. But if we could start by looking at the macro picture. So the last time we spoke, we were talking about this slowdown in the US economy. So is that something that you're still looking at? And what would be some of the factors that you are looking at right now?
Yeah, it's clear that unemployment's stagnant, and volatility is, I'm sorry, not volatility, but inflation's above pattern, above targets and trends. So there's a bit of a stagflation. The key thing that's really changed since last time we spoke, if we've had that decent correction in Bitcoin and cryptos, and at least a minor drawdown in the stock market, and decent, gold has still stayed on trajectory, and crude oil still declining. So overall, for the economy, it's economy seems fine as long as the stock market's a guide. The Fed's supposed to be cutting rates potentially by the December meeting, and market's getting happy about that. But I look at it as what's happening in the cryptocurrencies are indicative of where the economy is going. Because when you get to 2.4, 2.5 times GDP in terms of stock market capitalization, stock market becomes the economy. And this is where the answers change. And most economists haven't figured that out yet, where if the stock market's up another 10%, that's 20% of the economy, that's inflationary, and they'll keep inflation stagnant. And anybody running for re-election will be told that inflation's a problem. And my Trump administration's figured it out. If the stock market drops down 20 to 30 or 10, 20%, that's very deflationary. And that's will get those post-inflation deflation forces, which is kind of my base case at some point. The question is, has that started?
Yeah, that's very interesting. So would it be right to say that you can look at the crypto sector and especially Bitcoin as sort of liquidity slash sentiment
Sure.
indicator?
Oh, completely. Well, first of all, Bitcoin definitely, the rest of the space even more so. And when you see, there's millions of these coins, so-called cryptocurrencies, just number 9 is Dogecoin. It's a joke. It tracks its $22 billion as we speak on November 24th. It's launched as a joke. It means nothing, attracts nothing, and it's still being held up. It's pretty high valuations. To me, that's what's going to happen. At some point, we have to flush out all these excesses in this space, which is very indicative, and maybe even worse than the dot-com bubble. And then we'll get to a decent plateau. But for now, yeah, for these things to stay elevated, yeah, that's a pretty good sign of speculative excesses in markets. And so far, yeah, on the year, the Bloomberg Galaxy Crypto Index, as we speak, is down 20%. Not a big deal. Its volatility runs like 3 to 4 times the S&P 500. It was up 25% earlier. So to me, the leading indicator is pointing down. It's coming back as we speak, but that's the key thing to harness. And one of the key leading indicators I watch is that Bitcoin to gold ratio, and it's broken down pretty hard. So all my leading indicators are pretty negative, and with one major exception, the stock market's still strong.
Yes, and so would you possibly have a certain targets for Bitcoin as we're sort of
Sure.
falling down on right now?
Yeah, so ultimately, I'm just repeating the same thing I said back in 2018 that's likely to lose a zero. And I said that when it was above 100,000. So that means 10,000. That's been a normal correction. 2018, it did 70% of that, actually almost the whole way. From once I said it around 10,000, the bottom was 3,000. But I think initially right now I'm looking at 50,000. That's the key level that matters. It's been for the last 4 years, 21, 22, 23, and 24. It's been either a high or a low. It's a major inflection point. I think it's a normal reversion space to expect, particularly if one key thing happens. Vladyslav, and that is if stock market volatility recovers. So right now, as we speak, 100-day, 120-day volatility, S&P 500 is buried. It just bottomed around 9%, which was the lowest since 2020, and it's up around 11%. But if we end the year here, it'll be the lowest level for this volatility since 2017. So that's the problem right now. Is cryptos have started heading lower. MicroStrategy led the way. Gold's parabolic. Crude oil is declining. These are all global deflationary trajectories, but the rest of the dominoes haven't tumbled yet. The key thing I look at is all we need is a little normalization, mean reversion in stock market volatility, which always happens, and the dominoes are tumbled. But we'll see how that plays on to the end of the year, and that's still my base case that volatility is going to pick up and stock market's more likely to follow cryptos.
Very interesting. If we could move on to gold. So gold is still holding strong. I suppose the main factors that got gold to these places from the fundamental perspective, the central banks buying and everything, that's still here. But how are you viewing gold at this moment where there's so much uncertainty and the price is relatively elevated as well?
So I appreciate you pointing out the fundamentals because they're known knowns. They're widely known. What really boosted gold was the unlimited friendship between Vladimir Putin and President Xi of China in 2022. Now, it still took forever to break above 2000, which is part of my pain, but it finally did that. So the fundamentals are quite common. And Mr. Trump, I mean, gold loves President Trump pushing back on the Fed and things like that. And obviously, this unstoppable deficit spending in virtually every country in the planet, not the U.S. So we get the fundamentals, but at some point, you have to switch over to technicals, to being a risk manager, and I have. I'm looking gold as a risk management standpoint. It's just too stretched. Gold right now versus its 60-month, 30-month, 40-month, 50-month moving average is the most stretched in probably almost 45 years, right there, those peak in the late 79 and 80. So it's very stretched. But one thing that's never happened is gold has never got this high velocity of a rally relative to most of its moving averages, even its 200-day, without stock market volatility on the rise. It's never happened. And obviously that's since 1971, since we came off the gold standard. So is it a precursor for stock market volatility to pick up, or is it a feint? I think it's more likely to be the former. And I think it's, for instance, last time when gold really got expensive and peaked around 2008 or so, stock market volatility, which is 11% right now, peaked around 60%. That's 120 days. So that was about a year later. So I'm worried about that factor because when the world's ancient store value blasts off at this high velocity, it beats everything. It basically grabbed alpha from everything. When the store value takes alpha, I worry, and I'm worried. And at the same time, we're having plunging crude oil. Now, crude oil is the world's most significant industrial commodity. Obviously, it's not showing signs of demand pull inflationary forces. It's showing the opposite. But that disparity between, as we speak, crude oil down about 20% and gold up about 55%, which is roughly 75% disparity. The most ever was in 2008, and the difference was 60%. So this is truly historic what's happening. So I look gold, and I'm really concerned. I view gold as just purely frightening. So as we speak, it's just above 4,000. It's around 4,100. On a normal backup correction from these levels and normal history going back since 2071, you can easily get a 1/3 correction. Since 1971. And that means around 3,000, 3,500 is key support. And if we stay in the current trajectory and get towards 5,000, that kind of, the only time in history we've got this kind of high velocity rallies was at the peak, most notably the peak in 79 and 80. So I'm really concerned about what gold means here. So that's why I look at it. If you've been, as I've been saying, overweight and bullish gold for forever, there's never a problem to take profits. And it's part of the reason I'm really concerned about the entire market, because if gold takes alpha and it's this expensive, what happens as we tilt forward from this phase? And with the stock market very elevated. And the key thing that gold's not really expensive against is the stock market so far. It's just kind of catching up.
Yeah, so you partly answered my next question, Mike. So I was looking at many charts, and gold is pretty much outperforming most of the sectors. So would that sort of indicate a capital rotation event? And if it does, would that not indicate that if we do get this, slowdown, crash in the stock market, or at least decline, or some way normalization, things should look even better for gold then?
Yeah, they will, but look what happened in 2008. I think it's a very similar situation. In 2007, gold was up 30%, and then in 2008, it got to 1,000 and corrected 30%, and then it went back to that level. But it was a pretty severe correction. We're seeing very similar things now. The thing is that's different is the stock market is almost twice as elevated as it was then versus GDP and versus the rest of the world. It's twice as elevated versus then versus the rest of the world, stock markets, and volatility is extraordinarily low. And of course, now we have things like cryptocurrencies, which are wonderful things to speculate in. So I look at it as I'm just frightened by the implications of it going parabolic at this velocity and whether the next moves. Now, momentum says 5,000, but I point out I'm not going to just go say it's going to go there right away because that is a historical statement of a high velocity move. So I'm just kind of looking at it. It's never wrong to take profits in an asset that went up a lot.
Certainly. And Mike, where does silver stand in the middle of all this chaos?
I love watching that silver to gold ratio. Right now, it's about, as we speak, it's 80.82. The low for the year has been around 79. This 80 level has been really good support for a couple of years now. And the high for the year was 105 in April. And that happened when volatility spiked to its high and the stock market collapsed. You see the inference there right now? Volatility right now, 120-day volatility is very low at around 11%, and the gold silver ratio is near the bottom in the support. I think it's more likely to rally towards 1,000 as volatility picks up and maybe the stock market rolls up a little bit. Rally towards 100, then stay below this 80 support level. So that, and it's been happening for a couple of years now that silver trades 2 times of the volatility of gold. It's known as the devil's metal for a reason. It's known as leveraged gold for a reason. It typically outperforms by 2 times, and it's been underperforming. It's basically going up about the same amount for the last 2 years, the same 100% over 2 years. That's a very poor sign for silver. So I'm still bullish, but when we get some stock market recovery and volatility, a little backup, then silver is most likely to continue underperforming, and then gold would be the only major metal I think to go down the least initially, but go up the most. Particularly silver, I put more in a bucket with copper, industrial metals now, more so than every time in the past, and that's what's changed. It's much more of an industrial metal.
And would you pay at least some attention to this 45-year large cup and handle in silver from the technical
Oh,
perspective?
sure. Yeah, we got it. It's bullish. But it's one of those things we all see it. We all get it. I always try to focus on things that I can add to the conversation. I get it. It's bullish. It should go up. I don't deny that. I'm bullish silver, but I'm much more bullish gold, particularly with what I see potential deflationary forces in stocks and potential mean reversion in stock market volatility. Now, that's a short-term indication. We're taping on November 24th. By the time we get to a month from now, we'll see if that stock market's volatility has picked up. And if it has, those are dominoes tumbling into year-end. Now, if volatility hasn't picked up, then I'll have to reassess my view for now. But I'm not bearish silver. I'm just more bullish gold, and gold has been pulling up all the metals, particularly the PGMs, platinum, palladium, silver, and even industrials. You can tape some beta from gold to aluminum and copper too. It's just leading everything. So I'm sticking with the leader.
And yes, so most people who I speak with, they look at this gold to silver ratio and they would expect some sort of historical normalization, but you would not be surprised to see it go the other way, the opposite way.
Unfortunately, yes. And I was on a panel in February. The young man was pointing out the reversion potential. It was running around 80 there, popped up to 105. And if I was saying that it was a trade, I probably wouldn't have stopped out. But where do you go next? The bottom line is gold silver has been around for hundreds of years, that ratio, and it almost always goes up when stock market goes down and stock market volatility goes up. As I pointed out, stock market volatility right now, not the VIX. The VIX is running around 20. That's elevated. But the actual volatility for the last 120 days is about half the value of the VIX, which is historically very low. That's just not a time to be expecting. You got to expect the lower plateau volatility to stay low and continue lower. Now, it can do that for elongated periods of time, but in this environment, I think it's unlikely. So that's part of the problem. And we've also reached the huge plateau, I think, of U.S. stock market valuation versus the rest of the world and versus GDP, where unfortunately it's the 10 now that matters. And everything. I really can't have opinion on copper anymore without saying, well, okay, copper will go up as long as stock market goes up. Crude oil is going down despite the stock market going up means it's doubly bearish. It's just how things are now. We are so stretched in our financial assets and the financialization of the economy that that's the kind of thing I think that cryptos are picking out a little bit of an end game in that area.
Hmm. Yes, I would love to go deeper into the crude oil. So at the current levels, it looks very weak, and with potential recession and even further slowdown, things don't look good for oil at all and for the producers as well.
No, correct. So, but the thing is, it's a normal cycle. So when it was broke above 100 in 2022, I started calling for 40. Yeah, it was early, it was dumb, was stupid, fell on the mat, but still heading that way now. This year lows is 55 in WTI. 55 is about the U.S. break-even cost of production. So typically you have to get below that break-even cost of production, depending on how you measure and where it is, for a reset of excesses of supply versus demand. Now we know we have an excess supply versus demand now, particularly because prices went up too much. We incentivized the shift in the market. We accelerated that shift away from fossil fuels towards EVs, and that's just accelerating now towards a normal low for the last 20 years. It's been around 40. So we need something to change in that big picture dynamic. And what's really shifted in most of those times we made lows below around 40 in the past, starting with 2008. The U.S. was a net importer, and even in 2020, we were still just about break even. Now we're a net exporter, and China's demand is declining. Most notably their imports. I mean, they've been filling up their strategic petroleum reserve as we have. So something have to shift, but it's not, crude oil is not alone. Natural gas is a similar problem, and certainly all the grains, corn, soybeans, and wheat. They're all and a problem of finding low price cures after spiking too high within a world that's moving so rapidly in terms of technology. Now it's creating demand for things like copper and silver, but not for fossil fuels. And they're easier to create and substitute every day. So I look at this as a normal cycle, and I look at, so my key theme for next year is we're going to see, most likely see energy deflation, meaning crude oil is more likely to go to 40 than stay above 70. 70 is pretty good resistance. Natural gas, as we speak, U.S. natural gas is right now about $4.50 per MMBTU. If we close the year there, it'll be the highest close since 2009, and we're elevated because last year we had a colder than normal winter, despite global warming. So if we get a second colder than normal winter, which the market's already priced for, despite global warming, then natural gas might stay elevated. My bet is we're going to get a reversion higher in stock market volatility. We're going to get a resumption of global warming trends, which means energy prices are much likely to go lower into next year. And that's why I'm putting $40 WTI as a potential target. And if you just look at natural gas since 2012, the average lows have been around 2. And right now we're at 4.5. Again, it's also priced for winter pricing at the moment.
Yes, again, very interesting, Mike. If we could talk about sentiment in gold. So I talk to a lot of people about gold as well, and most of them believe that it's still mainly the big players who are driving the gold price. Because if you look at GLD ETFs, up until recently, we still had outflows and things like that. Also, I was looking at the junior mining stocks performance, and they still haven't reached the previous high. So would it be relatively accurate to use junior mining stock performance as a indicator for sentiment as well?
Sure. Well, they're making money. It's good to see. And the thing is, I like to watch that GDX, the VanEck Gold Miners Equity. If you take the GDX divided by GLD, it's been going down since about 2006, once they both can trade it. Now we bounced this year, but it's bounced to good resistance. And the key thing to remember about gold is we know the top central banks on the planet have been buying gold. That's the significant. They're not buying the miners, but the miners are making a lot of money. I heard the average cost of production is below $2,000 an ounce. So that's great. How much further it goes, I don't really know. I don't watch the equities as much. I'll just point out that GDX or GDL ratios had very good resistance. But the key thing to remember about gold is what I'll restate from the very beginning. At certain times, as a strategist, I switch everything and switch over to my risk management hat. And my risk management hat was tweaked because silver's stretch versus almost every moving average. You can start from 200 days out to 60 months has stretched the most in almost 50 years. I mean, you can get well past those stretches in 2008 and 2011 for a little while, and almost every time it proves you're not supposed to be long gold there. Now, I get the fundamentals, but quite frankly, I put it in my DI list. I deliberately ignore the fundamentals when we get this stretch, and I focus on I'm your risk manager. I'm walking out to the desk. I see 8 traders all long gold, and I'll point out, here's your risk of being long gold here. You had a great year. Highly, it's a very risky asset now. If it continues higher, it's what it means for everything else that makes me absolutely frightened. So if gold continues on this high velocity rally, just imagine what it means for the stock market. That's what I'm worried about. And to me, that's the key things I point out is never hurts to say take profits in this business.
Certainly. What about bond market, Mike? Does are there some indicators that Fed is potentially not in as much control over the interest rates as they would like to have?
I think the bond market is the next big trade, U.S. bond yield. So I'll make it simple. First, and I'll admit my viewers and our listeners will say, yeah, McGlone, you've been saying that for 2 years. Right now, the 10-year note yield's at 4.04. In China, it's 1.81. In Japan, it's about the same. In Germany, it's a two-handle approximately. Top economies in the world have much lower 10-year note yields. That's a key factor. I think it's just a matter of time the U.S. goes that way. And there's one key trigger, just a little pickup in U.S. stock market volatility, which right now in 120 days, 120-day basis, if we end the year here, is the lowest since 2017. So you see where I'm going with that. To me, that's the next big trade. And the reason I say that I've been a skeptic of U.S. stock market for too long, but I was able to find some great alpha in Bitcoin and cryptos. And that alpha worked great until last year. Now that alpha's dead, they perform horribly. People are just realizing they're just selling speculative digital assets. But I switched over to gold. And the gold alpha really just grabbed the baton of alpha this year. Now that alpha is getting stretched. To me, the next alpha is the U.S. Treasury long bond. So that's my base case. It goes to 1.8%. We get maybe a 10 to 20% correction in the U.S. stock market, which right now means nothing. But that would be following the lead of Strategy, which is leveraged Bitcoin. Bitcoin 200-day moving average has dropped. Strategy has dropped. S&P 500 is just heading towards there, and maybe gold at some point. This is where I point out that deflation following inflation is normal. It's happening in crude oil. Gold might be picking up on it, and the stock market's the last thing to notice. And the key thing that's really happening in China, as I pointed out, that 1.8% 10-year note yield shows, yeah, that's deflation despite massive fiscal and monetary stimulus.
Mhm. So, Mike, just to put it a little bit everything together, of course, not as a financial advice, but how would you be thinking about structuring a portfolio in the current environment between different asset classes?
So I enjoyed this question. I can't give investment advice, but I clearly tilted towards overweight gold and treasuries at this time last year, and I stick with that. I don't know why I should change that, except when you when you suggest things like gold's going to go up a lot, and if you're any investor and it's an overweight position in your portfolio and you beat everybody in a world that you're not expected to beat everybody, you're supposed to say thank you and never mess with the market gods. And so, that's my fear is that strategy that I kicked in over a year ago will continue to outperform everything. And that's more risk off assets.
And you mentioned China, Mike. Uh, so they're pretty much printing money, and so some would say are buying a lot of gold using that money. So are they trying to devalue their currency intentionally as well, in a way?
So let's probably focus affecting macro big picture. I don't know what they're doing with their currency. Let's point out, I think it's been 37 straight months that Chinese PPI has been minus. Right now it's minus 2.1%. It's been a lot lower. In June of 2023, it dropped to minus 5%. And that's despite debt to GDP running around 300%. That's not just my estimate. That was an estimate from Goldman Sachs. And that's also despite money supply running 40 to 50 trillion dollars, which is double the US. So they're massive liquidity pumping in the system, and they're getting deflation. So the key thing, I think, to look at China's guidance is only getting worse as they're trying to export more of that inflation to the rest of the world. But this is what happened in Japan. And we're just one little small little stock bear market away from that same trajectory, is the way I look at it. And that's where never has the entire world's economy depended so much on that U.S. stock market remaining resilient. Key leader for that is Bitcoin and cryptos, and they've all started rolling over. One of my key favorite leading indicators is the Bitcoin to gold ratio. As we speak, it basically takes 21.6 ounces of gold per one Bitcoin. The high when Trump got elected was 40. And we have a model that says it should head to 13, and it almost always goes down when stock market volatility bottoms, just like the gold to silver ratio bottoms from a very low level. Question is how long can stock market volatility stay very low? It basically running about half that of the VIX.
Right. So, Michael, we covered a lot. Is there anything else that maybe you would like to mention that we haven't covered yet?
Yeah, the key thing I think, Vladyslav, is how we end this year. I'm very concerned that the U.S. stock market is just going to follow what Bitcoin did. It had a great year, and now it's down 6% on the year as we speak. And if the stock market does that, that begins a pretty significant, great deflationary reset. And here's one thing quote I'll mention is we've only had 2 down years in S&P 500 total return since 2008. We're way overdue for another one. This year is kind of a long shot, but once we get that, maybe it's next year, we'll get a nice reset period be able to reset all risk assets. But we're way overdue for that. It's just a matter of time.
Mm-hmm. So, Mike, great information as always. I have really enjoyed our conversation and thank you so much for your time.
Vladislav, thank you very much for having me.